Welcome to our Beat the Banks trainings from here at Beacon DeFi. I'm Chris Soriano, co-founder of Beacon DeFi, and I welcome you to some of the best trainings to help you escape the rat race and become a smart and competent DeFi investor. For most people, getting started is the hardest part, so watch these videos as many times as you need to, share them with your friends and family, and if you have questions, comment below. Even better, join our free community, Total Value Locked, where we host these Beat the Banks trainings every week. Join the hundreds of people who have already started the journey to making DeFi investing the key to unlocking the potential generational transfer of wealth that DeFi represents. The link's down here in the description, and I'll see you in there.
Okay, so let's roll. December 8th training today. We're going to recap what happened in the last training, talk about tokenomics and supply today, where we look for in farming positions, and we're going to set up a couple. So last week we talked about just coming back, getting in. 2 trainings ago on Black Friday, I talked about things that you may have missed narrative-wise. Last week we actually, set all that up for anyone who's brand new. Set up a Rabby wallet, because Rabby is what we're rolling with now as our official recommendation. And again, that's at rabby.io. We'll be using Rabby along with my hardware wallet here moving forward. So just wanted to, let me find my hardware wallet. Probably be good. Oh, it's going to be one of those days, guys. Hopefully everyone's having a great week. I'm excited for what's to come. Okay, so moving forward. Thoughts from the last training again. If you set up a position using Rabby last week, if you're one of our faces last week, and thanks to all the new faces, love seeing that. So please tell your friends we're back on these trainings every Friday at 3 p.m. Eastern. There's a lot of farming opportunities right out there right now. Hopefully you're enjoying using Rabby. I think it's a big quality of life adjustment. Of course, you can still use MetaMask if you like, but Rabby's built on top of MetaMask using the same code base, and it's from the group that is behind DBank, the great dashboard application. So ultimately, they've put a lot of care in the last 2 years in making Rabby a much better product than where it was 2 years ago, which was just kind of Now it's like, in my opinion, one of the wallets to use. Coinbase wallet is also a pretty decent one too. We talked about them on the Wednesday call. So again, if you're new here, we also have a call on Wednesdays on our YouTube channel at 1 p.m. Eastern. Feel free to check them out. Check us out, myself and Jangles. We talk about news of the week and various other things along with these free trainings every Friday. These trainings do go for an hour, so we're going to go to the top of the hour, and I'll be posting the recording in a couple hours. Any questions you have, go ahead and do that on our Beat the Banks website. Put the link for it here. Go back. And that is btb.beacondefi.xyz. And if you have an old bookmark, you can still get there using beatthebanks.circle.so. We use the Circle platform for our community, and this is our free community. Feel free to lean on us, help be a great community member for others as we've relaunched Beat the Banks here with Beacon. Good time to accumulate ETH. We talked or just a little bit ago on our mastermind call. The ETH BTC ratio is roughly about 0.054. Django does believe it's pre-programmed to go to 0.1 due to the huge moves that BTC is making over the next couple of months. And ultimately, historically, ETH and other altcoins normally lag behind and raise along with it. So definitely see some movement with BTC, which I think means this is a good time to accumulate Ethereum. Whether you get it at a CEX like Coinbase, or if you purchase it in DeFi, you should be accumulating, because you definitely need those blue chips. Because if you don't know, we are in the beginning of a structural bull market. Jangle and Jangle called this the week before we were in Miami, actually. So yeah, hope you're seeing a lot of action. There's a ton of action going out right now. Congrats if you were on Solana and you got the Jito airdrop. We have multiple people in our mastermind that were in on that, got gigantic airdrops. Pretty much just free money. So we'll probably cover that in a future training, but for now we're going back to the basics. So 2 weeks ago was what you guys missed. Last week was getting back in. This week we're building on top of that. We're going to be doing a couple positions. But first, just like last week, we're going to talk about security. So did you get a hardware wallet? Did you set it up? Again, if you're looking for a hardware wallet to buy, get a Ledger. Well, The first one that we recommend is the Trezor. Get up there. Yep, it's open source. You can get the Model 1, which is it was on Black Friday for like 45 bucks. It's like 79 bucks. You can get the new Safe 3, that's their newer wallet. Probably better build quality, not as old. Probably the one to get. Also has multi-sig wallet support, which you probably will never need, honestly, unless you really want to go that route. But it's the newer model, so I'd recommend that. On a Ledger, go with the Ledger Nano S Plus. It's 79 bucks. Comes in great colorways. I personally love the clear orange one. And they both support plenty of tokens. Don't get the Nano S anymore. Too old. Nano X definitely is showing its age. So the S Plus is going to be the way to go there. I do have a couple other here. I have a Keystone Pro. I don't have a Grid Plus Lattice one. That's what I'm looking at as well, but can't really justify the cost. It starts at $350, and basically it's a gigantic terminal. And then your hardware wallets are these little credit card things you slip in. So what's cool is you can buy multiple of these cards, and those represent a seed phrase, and then you can just plug them in. So you can have multiple Grid Plus machines and just move the cards back and forth. So in any case, if you got one, awesome. If not, go order one, because not farming with one is way worse than farming. Yeah, it's safety wise. You definitely want to use one. As long as you have one, your chances of not getting hacked way better than not having one. And then obviously, if you installed Rabby or MetaMask, but with Rabby, did you connect it? We showed that last week. It's in the staff trainings on Circle if you want to check that out. Pretty easy to set up, in my opinion, pretty straightforward. Make sure you have a crypto-only email. That is still key. You don't want to use your personal email here in this space, because if you get compromised by clicking on a bad link, or someone phishes you or tricks you into doing something that you shouldn't, and hopefully that never happens to you, they can go into everything personal that you have, and you don't want that. Also, same with a VPN. Again, the main reason you use a VPN is to scramble your traffic. You don't want any of these bad actors and advanced technology out there just snooping on your financial stuff, what you're doing. And there's nothing illegal about using a VPN. Again, it's for just making sure that your traffic is secure. And that's especially what you want. This is your hard-earned money. You want to make sure that you're holding on to it and getting the gains you want. Do you recommend using a password manager? I like 1Password. Do not use LastPass. Never, ever, ever again. They've had multiple breaches. It's just bad news. So if you don't want to use 1Password, you can use Bitwarden. That's free. Another one is KeePass. You can set that up locally. If you're very tech savvy, KeePass is still awesome. Doing it on like a separate PC on your local area network that's not connected to the internet, that's a boss move, in my opinion. You got to be really up on your security if you want to set that up. Also, if you're going to be using a password manager, do not use the same email that you have for crypto in that. Also, another tip. I know this means that you're going to have multiple emails to take care of, but these levels of buffers that you're between yourself and bad actors, in my opinion, well worth the peace of mind. And you want to practice wallet and session separation. What I mean by session separation is if you're using Chrome, if you're using Brave, you have the ability to set up different profiles. I recommend you do that with a lot of things. Just make it so that if you're on different ecosystems, you use one. Like I have one specifically for Solana, I have one specifically for Ethereum, and I have one specifically for Cosmos. And just mainly because I want to practice that good wallet separation. So because they all use different wallets. I use Phantom for Solana, I use Kepler for Cosmos, and I use Rabby or MetaMask for Ethereum. And you want to make sure that you have those separated just in case there's ever an issue. And having that compartmentalizing of your risk is super important. Okay, let's talk about a couple concepts moving forward. So you're going to hear us talking about these during our calls, during content that you're going to see with these guides that we're releasing in the next couple weeks. You're going to see a lot of these terms, and you'll make sure that you guys know what they are. The ones you're going to hear the most are probably these four. DEX, which is a decentralized exchange, that is basically just a protocol where you can go to swap assets in a decentralized manner. Decentralized meaning that no one entity owns the servers that they're on. They're normally brought up by a huge network of I guess you could say they're privately owned computers. I guess they are because they're all technically nodes and validators that help provide the infrastructure that all of this liquidity sits on top of. A centralized exchange, or what we call a CEX or a CEX, depending on how you want to pronounce it, it's up to you, is someone like Coinbase, Binance. Yes, they also provide lots of services to swap assets or even providing markets in terms of an order book market for purchasing spot BTC, spot ETF, limit orders, stuff like that. That type of stuff you'll find at a CEX. The difference between that and a DEX is that a CEX, their machines are all owned by one entity. So all the servers that provide the market data, all the mechanisms to purchase assets at Coinbase or Binance are owned by Coinbase and Binance. So the reason why we don't want you to use a CEX like a bank is because that your funds are on their system. You're not holding them. You're not holding them in self-custody. Now, when you withdraw them, sure. So if you want to use this, if you want to use a CEX for trading because you just like they have like established, mature, robust systems that allows you to do that, that's great. Feel free to do that. Just keep only funds that you want to keep on there for that. Keep all the rest of your funds in DeFi. You want to make sure that with self-custody, you are self-custodying those assets and you have control over them. You are your own bank. That's why we're all here. We're here to beat the banks, right? LP, liquidity pool. This is basically a smart contract where you are providing liquidity for assets. You are lending your liquidity to a protocol in an LP, and they are paying you an incentivized yield for doing so. That's what yield farming at its simplest definition is. AMMs, automated market making. This is the mechanism behind most DEXs. Now you can have order book. Order book and AMM are a little bit different. AMM is based on liquidity and balancing that dynamically through an algorithm. Order book is the buy, sell, maker, taker type of system, right? And you put out an order and someone has to either buy or sell to fill that order for you. That's what you'll find in most centralized exchanges. There are some of these in the DeFi world, specifically at perpetual DEXs, where you can actually do buying of spot assets in a decentralized manner on a DeFi protocol. GMX is the biggest example of that. There are others like DYDX, Gains, there's another one, G-Trade, Vela, Buffer. I mean, there's dozens, right? Perp DEXs are a huge fad right now because not only can you do those trading services, you can also be paid pretty handsomely as liquidity provider for those protocols. An AMM can be a variety of things. It can just be, the mechanism behind the liquidity pools at a DEX. It can also represent a lending AMM, meaning you can provide collateral supply and then borrow an asset against that collateral. And that's to me, when I first got into DeFi, 3-4 years ago, that was the easiest way for me to do things. When I first got here, I did nothing for 45 days because I wanted to soak it in. I wanted to figure out what exactly I was doing. And the first thing I did was I went to Aave, which is aave.com. And to me, that was the most relatable thing because it's just like going to a bank, right? You're going to you're going to present assets as collateral and you can take a loan on that. To me, that was an amazing concept because normally if you go to a bank like I'd like a loan, they're like, well, do you have an account with us? Yes. Well, fill out these forms, and if you have a good credit score, our underwriter or loan officer will look at everything that you have with your assets. All of this bullshit, right? So it's like the one thing about being your own bank is that as long as you have the liquidity, you're going to get the loan, which is a beautiful thing, and you get paid for both supplying the collateral, and in some cases you can get paid to borrow, which was a very powerful concept when I first came into DeFi. So yeah, take advantage of these things if you can. It can be really awesome. A couple other concepts I want to talk about. These are things we'll talk about or you'll see when you're out there. Slippage. It's the difference between the expected price of a trade and the price at which the price is executed at. Now, you'll find this, of course, in order books, but on a DEX level, normally what that means is if there's a lag between when you go and swap the assets and when the price is done, you could actually get less back. So if I'm swapping between ETH and USDC, I may be promised a specific amount of tokens, but if slippage is terrible, I've had to actually get less tokens back than I thought. That's because of any volatility that might happen. You won't see that very often. It's honestly pretty rare on anything with really deep liquidity, but it could happen on, you know, lesser liquid tokens or like shitcoins or something like that. That could definitely happen if the liquidity for that pool is deep and you have large orders coming through and trying to swap assets. That happens when that happens. You have what's called price impact, where and this happens actually when you're bridging as well. So if you're going between one blockchain to another, the amount of the liquidity there for what you're bridging over may actually be worse or it could be better depending on what's there. It all just kind of depends normally on your protocol. They'll show you if there's a positive slippage or a positive price impact, rather a negative price impact. And you may not want to do the trade if the price impact is very high. In some cases, you may not have a choice if you're trying to get out because let's say that a particular blockchain has undergone an attack. Stuff like that. You sometimes will just eat the slippage in order to make sure that you can actually get out of that position and solve any losses that you may have. So the takeaway for that is to make sure that you use DeFi Llama's aggregated swap or an aggregator to get the best price. That's the reason why we use them, is to make sure that you get that available to you. Question from the Q&A. Thanks for putting that in there. Where can we check the slippage? You can check that within the decks. I can show you a little bit once we get to the demo section. You can normally I normally set my slippage really tight because it's like if I'm swapping between ETH and USDC or between stablecoins, I want the max available that's allowed. And normally the smallest you can do is 0.1. Sometimes that will fail if you do it too tight, mainly because there's just volatility, right? So there's no guarantee. So I think if you're at 0.5%, that's fine. The highest you can do without it being crazy is 49%. And I know that sounds like a huge number, but when you're talking about certain types of meme coins or other types of coins, that can have a huge amount of volatility and very low liquidity, that's actually fairly commonplace. Or if you have specific coins, and we'll talk about them in a minute, that have like a transfer tax, meaning you have to pay X% on a buy or X% on a sale. Those happen. Those are super high risk. I wouldn't recommend you really dip your toes too deeply into that unless you know what you're doing. Then you have to adjust your slippage appropriately to cover those transfer taxes. So yeah, we talked about using DeFi Llama Swap last week. That is by far the best way to do it, and pretty much how all of us now do our swaps. We don't really go to DEXs if we don't have to. We just use DeFi Llama because it'll aggregate the aggregators, which is and they're already getting the best price. So whatever's the best price among those is the best way to go. This is the one that most people always want to ask about: impermanent loss, IL. Happens a lot in indexes that use liquidity pools. You probably don't see it that much in order books because normally those are filled and those get ARPed out pretty easily. It's a very simple definition. It's the difference between an asset in an LP between when you first make the LP and then when you break the LP. That's all that impermanent loss is. The ironic part is it is permanent, even though it says impermanent. But it's only impermanent because it's a realized loss when you withdraw your liquidity. Now, you can have positive or negative IL. So just kind of remember this when you're making your liquidity pools with assets with directional exposure, it can swing in either direction. I've been wrecked both ways. I've been wrecked on, when you get a token and you're pairing with something and then suddenly it goes to the moon. And because of the way LPs work, it rebounds and it actually sold a bunch of that token to buy the other token automatically, which happens in a liquidity pool. We'll talk about that in a minute. And I lost a whole bunch of tokens. So that is something that can happen. But these are things that you kind of understand or just take into account when you're doing a liquidity pool. So how do you minimize IL? First way is to don't sell. You can't realize a loss that doesn't happen, right? I know I say that a little bit tongue in cheek, but essentially that is one way to not get IL is you don't sell. If you don't sell, then you don't realize any loss. The more typical answer is if you want no IL, LP a pool that either has just stable coins or market neutral yields, or LPs that are highly correlated with each other, which is, in this case right now, part of the narrative is what are called liquid stake tokens or LSTs. And you can find that with Ethereum. So let's say you have liquid stake ETH from Lido, which is ST ETH, or which in this case is, you'll see it as WST ETH, what we talked about last week. We purchased that using DeFi Llama Swap. You can pair that with Ethereum. Very little IL there because you're farming the same asset. You have Ethereum and then liquid staked Ethereum, which is pegged to the value of Ethereum. So very little IL there, very much like farming the stable coin there. And the same thing with BTC and ETH, they correlate pretty well. They travel pretty well together, which is why in basket or ETFs that are available with them, you'll see BTC and ETH paired with stables, for example, like in TriCrypto or in some of these other pairs, like in GMX V1, the GLP pool. It's just weighed out so that there's very little IL when you're looking at it. The other way is if you are in a pool that's highly volatile, wait for the price to come back to the original ratio. The best yield farms are the ones that are cyclical because you want this sideways crab action, right? So you don't want it to be super, you don't want it to be, it's more of a gradual, right? You want it to be fairly flat. The most beautiful thing about what's happened in the last 12 months is that ETH and BTC have retraced to where they were a year ago, if not exceeded that. So even if you held for the last 12 months, you should be good on an IL perspective because we're back to where we started. So the takeaway with this, besides, talking about IL, honestly, I don't worry about IL too much, mainly because if I'm farming something, I'm only going to farm pools that have good incentives that in most cases will outpace the impermanent loss. So for example, if I'm going into a pool that is offering 1% per day in APR in terms of reward tokens or just LP, that means that I'm outpacing impermanent loss in most cases. I will look for pools like that. So yes, impermanent loss is a thing. Is it better than possibly just holding? It kind of depends. In some cases, it might be better to hold, but for me personally, I farm yield. I want my money working for me all hours of the day. When I'm awake, when I'm asleep, it makes me itchy when I look down and I see assets that I'm holding in my wallet. Why? Because they're not working for me. They're holding them, but they're not out earning yield, giving me more passive income. That is why I'm here. That's what I'm so stoked about when it comes to yield farming. And I hope that turns out to be the case for you as well. So how do we find farms? The easy question is, if you're a part of our Beat the Banks community, which you should be already, check out the Beacon Farming Spotlight. It comes out every Friday. Another one was posted this morning, I believe it was around 11 o'clock Eastern. And you get a little bit of the same alpha that we get with the Beacon Mastermind. So definitely check them out. Use reputable directories like a DeFi Llama. And what you're looking for is finding protocols with strong TVL. Protocols that have strong TVL or have been around a long time, they have what's called the Lindy effect. The longer that something has been around, the more you tend to trust it. So the products like Aave, even though the yields may not be great, you trust them because they're Lindy. Finding products like that or protocols like that are good for you from a yield farming perspective because you're going to find pretty good yields. The other place to go is major decentralized exchanges. So at DEXs, Uniswap, QuickSwap, Trader Joe, where's some other major ones? Camelot right now on Arbitrum, Osmosis if you're out in Cosmos, Radium, Jupiter if you're out on Solana. Any place you can find a DEX, the decentralized exchange, and they have liquidity pools, pretty safe to do that because your LPs are actually providing the liquidity for the entire operation. So you should be incentivized pretty well for that. GMX is a great example of this. As part of this real yield narrative that we have, because you're getting fees for people using the trading service as a GMX. When people use the service, you receive the benefits of that as a holder, as an LP provider. Again, that's the beauty of how this system works, that you're renting out your liquidity and you're receiving incentives for doing so. Other thing to do is ask the community. Get on Beat the Banks, go in the general and just ask, hey, I'm looking at these positions, and someone will respond to you. Let's build this community. Let's get people talking. These are the things that make things like Beat the Banks awesome. Question on any hard rules on what's considered strong TVL. It depends on the blockchain you're on, to be honest. If you're on a blockchain for example, Base is new. They have about 300 million TVL. I would think if you just looked and did a ranking on DeFi Llama based on TVL on protocols that are inside there, you may see anything in the top 5 should be fine. Otherwise, if you're like on Arbitrum, if you're on Avalanche, anything I'd say probably 50 to 100 million, probably a decent benchmark. Is probably what would work pretty well. But yeah, you don't want to be in something that has like 50,000 TVL because that means nobody's using it. The pools are very thin, big slippage, lots of price impact, and the APR won't be sustainable because obviously if you're like, oh wow, I'm seeing a huge APR on that, but there's like $50 in it, of course it's going to be that high. The moment more people go in, it's going to drop like a rock, and it will. It always will. So, great question. All right, so let's talk about tokenomics, and this is probably the meat and potatoes of this week. Things that you need to understand is yes, we're going to set up positions, but you need to understand the fundamentals behind them. Having strong fundamentals, strong foundation, and what we call pumpamentals. These are things that are going to help you survive in any market condition. We're going to talk about that next week as well when we talk about creating an all-weather portfolio. Tokenomics is just a portmanteau or a combination of 2 words. In this case, it's token and economics. I did not fill out the rest of this. My apologies. Look at that. Anyway, tokenomics comes down to 2 things, supply and utility. Supply matters, especially with distribution. Why? Because looking at distribution in terms of a protocol will tell you how good that protocol could or could not be. The one reason for that is oftentimes if you get into these large protocols, in most cases, you're not going to be the first one there. As much as we love being early in a protocol, the lindiest of protocols, you're not going to be early on. They've been around forever. That's why they're lindy. But you do want to make sure that at least from a token distribution standpoint, that it actually makes sense. Because you don't want to be in a situation where friends, family, and VCs got a whole bunch of these early tokens, and let's say there's 100 million of them. And then their piece is coming due in like the next 2 months because they vested for 12 to 24 months. And the idea is that they're probably not going to hold them. They'll probably sell them, get ROI back on their initial investment. And that's fine. That happens in all types of businesses, right? That can affect the price. So this is Convex. This is a yield optimizing protocol in mainnet. This is for this CVX token. And something like this, which you'll find on some research websites, gives you a bit of an idea on token distribution. One thing that you want to do is you start to build your knowledge on this is you want to keep a journal. You want to keep, notes on everything that you find because you can go back and compare notes as you go along in your journey because a lot of this is cyclical. There's always patterns with regards to how a lot of these protocols work. So with regards to what you're looking for in distribution, you want to make sure that ultimately the community benefits from the majority of the token distribution. In this case, liquidity mining in terms of token distribution from the initial mint. And sometimes you have your initial mint and then you'll have emissions until the token becomes fully emitted. And in this case, as emissions come through, the rewards can go through liquidity mining and also to Curve LP rewards because they are an optimizer for the Curve Finance website. And essentially, you just want to make sure that the tokenomics makes sense. If you're in a situation where the treasury or rather the team gets like 35, 40%, and you're like, I don't know if that's cool. Because in the event that they soft rug or what we call leave the protocol, they run away with all that money. Of course, we want them to make money. There are ways for them to do so. But we don't want it to be at the expense of our token holders. So keep that in mind when you're doing some research. If you have any questions, feel free to post about it. Ask, like, are these tokenomics good? Or are they absolute garbage? And we'll tell you. Okay, so I wanted to bring this up because the Arbitrum airdrop was huge. Was huge for our community. We banked more than, I mean, the conservative number is $500,000. It was more than that, way more than that. I mean, we had people who had multiple wallets just from trying different things and got 5 figures in ARB. So you can kind of do the math on how much that is, because ARB at its highest point was around $2. A lot of people still think that ARB is pre-programmed at $2. So it's currently sitting around a buck, like 105, I think, right now. But yeah, that was a huge boon for us back in March when it came out. But this is an idea of how the distribution, in terms of how it's working. So the DAO treasury gets the majority of the drop, and then team and future team, and I don't remember what this portion is here, the 26.9. Oh, sorry, team, future team, and advisors. You kind of have to do some research and find out if this is a good thing or not, because this is a little bit of a large number. But the one thing that is that you have to find out about this, I think this is locked for like 3 years, and it's on a cliff, so they can only claim so many at given times. So the treasury has been really good in terms of just giving back, I guess is the word to use, because like 63 million, was it that? No, 93 million ARB were not claimed during the airdrop that we talked about here on Beat the Banks multiple times. There are people who didn't claim 93 million worth. So actually went back to the treasury and they used it to fund the short-term incentive protocol, the STIP, that much of the farms that we have on the Beacon Farming Spotlight are the beneficiaries of, because they're taking those rewards, they're giving them back to the community through the protocols. So you are getting extra yield based off of these things to go and get more yield, make more money back. So yeah, like a stimmy check, right? But yeah, understanding how supply distribution matters. Again, we looked at the CVX token. Now we're looking at the ARB token. And again, you just want to make sure that the tokenomics are okay. Treasury having most of it is fine, because that means they're going to do something with it. And because it's the DAO treasury, it's a DAO, or a decentralized autonomous organization. That means that they have yielded any decision-making power for the, in this case, the ARB token, to the DAO or the community that's overseeing everything that happens here. So everything that happens has to be put to a vote. You can make the case that this is a bit of a plutocracy, because the more ARB you own, the more voting power you have. So people that have the most say, but that doesn't mean that always means that they're going to win. I've seen in many cases where you can have coalitions of people who don't agree with something. It's just kind of how it works, and that's how DAOs work. In a lot of places, it works really well. So something to consider if you're looking to get into governance. This is what this means. If you're looking at governance, you're going into the DAO itself. You get to vote on proposals. You get to feel that, I don't know, that sense of grassroots belonging. You're like, I'm a DAO member. I hold the governance token. And in some cases, the governance token can be worth a lot of money. So keep that in mind. If you're farming airdrops for governance tokens or other types of tokens, they can actually be really good, because you get this power and you get special benefits specifically for token holders. They try and provide as much utility for holders as possible, at least in my experience. Okay, so let's talk about utility. That's the biggest thing that you're going to have to look for when you're looking for what am I farming? I'm farming this token. What does it mean to me? So when I'm looking at what the utility can be, it could be a variety of things, right? So we can look at the staking for additional value, the locking of the token to prevent sell pressure, increased APRs for the protocol's native token. That's normal in higher risk farms. Protocol perks, meaning you get if you're an ARB holder, or if you're a particular, let's say for example, on gains, which is their token is GNS. You actually do, if you're a Gains holder and a Gains staker, you do get a piece of the protocol rewards. For people using it, they'll go back to Gains stakers, in addition to being an LP holder. So there are perks for doing that. Sometimes you get early access. A lot of times when new protocols will partner with protocols, they will provide early incentives for people who hold the native currency or the governance token. You can get those types of benefits for doing so. That's not the only place that has utility, but what you're looking for is utility. Especially if you're going to be holding a token or farming it. I mean, if it's a token that has no utility, just farm and sell it, harvest it. You can certainly do that. But because the one thing you definitely don't want to do is you don't want to hold a token that has zero utility, is programmed to go to zero, and you're holding a ton of it with nothing to do with it. So always look for tokens that have utility. A lot of them do have an interest-bearing mechanism where you can actually just hold it and you'll actually earn rewards. You will see this you'll see this in let's see, what's a good one? Probably liquid stake tokens. Those are interest bearing, although it's not a governance token, but I mean that doesn't have to be. This is just general tokenomics. Overnight finance have these collateralized debt position stable coins called USD plus and DAI plus, and you actually earn yields just for holding it because they take the money that's used to mint them, because they're actually collateralized, so you actually have to provide collateral to get USD plus or DAI plus, and they actually take those funds and they put them into other yield bearing liquidity positions in other spots across multiple chains. So the rewards that come back, a portion that goes back to holders. So that's what we call a rebasing stablecoin. So that part's pretty cool too. So ultimately, there's multiple ways to earn yield. The real question is you just have to understand how that happens, because one question we get a lot is, where does the yield come from? And if you don't know where the yield comes from, I will give you one hint as to find out to where it comes from. Just go look in the mirror because it's coming from you. So keep that in mind, and keep an objective look at that. Answer your question, Steve. Yes, you are getting the exact listings that the mastermind gets. All right, so some questions to ask with regards to tokenomics. What is the current circulating supply of the token? And we can see this if we're looking at something at CoinGecko. You'll get both the max supply, the current supply, and the amount in circulation, right? You want to make sure that because that's how you figure out the floatable value and the market cap, based on the supply times the price and then the max supply times the price. Helps you figure out if the token is at a decent value or if it's overvalued, that type of thing. You can actually look at charts to correlate that with if a token is being oversold, overbought, understanding hype patterns. There's a whole rabbit hole you can go down from there with regards to tokenomics. When and how will we reach the max supply? This is actually an important one, especially in the case of Trader Joe. Joe just became fully emitted last 2 weeks ago. So unless they do something, there's never going to be any more Joe created. So that makes Joe a fixed supply resource, which should, in essence, if they start burning supply, raise the value of Joe because it makes it more scarce. Can they do something to fix that? Sure, they can release a new Joe token, I guess. And then you can just, with new supply tokenomics, and then you would just turn in your old Joe for the new Joe, pretty much like what they did like in Europe when they had devalued currencies, they created a brand new one. There's a new version. That's certainly something they can do. I don't know what they're going to do, honestly, but that makes Joe a pretty interesting proposition. If you have any, I have a bag of Joe that I keep staked auto compounding. So that's something that if you have Joe, something to look into. You also want to find out who holds the majority of the supply. So if you're going into a brand new protocol and you're looking at supply, you can take a tokens contract, put it in the blockchain explorer, and you can find out who holds the majority of those tokens. If it's just one or two wallets that's not a contract, that means somebody came in and sniped that entire supply and they will start selling on you. You don't want to be exit liquidity for, some of these bots that are out there. Can you stop them? No, honestly, but just kind of keep that in mind. But the sooner those tokens leave those wallets and get into investor hands and come to the correct pricing where it should be, the better off a protocol will be. Again, we talked about what's the story of the tokens promised to early investors. That makes sense because you have people who help bootstrap your business. You want to get them, make sure that their investment is covered before you move forward. You want to make sure that a project has locked liquidity. There are some projects that take a little bit of their supply and they lock it, meaning that they cannot touch it ever. And that's good for the ability for them to not just cut and run and rug a project. And what I mean when I say rug, that means scamming and defrauding your investors. You also want to find out if there's a tax, whether for deposit, withdrawal, buy, or sell. Those are all different concepts, by the way, meaning deposit or withdrawing. So if you make an LP position or if you're staking in their protocol, you may get charged an amount to do so. Also the same when withdrawing. There's also a buying and selling tax. So if you go and you're at a DEX and you exchange Dogcoin for USDC, you may have to pay a 5% tax to do so. It just means that you'll get whatever that amount is minus 5%. It's just kind of the cost of doing business. Is it great? No, but when you're dealing with a lot of low cap coins, it's kind of the norm. Yeah, that's all I can really say about that. Just based on experience, it's just kind of the norm. And where do the proceeds of the tokens go? You want to know if in terms of revenue, obviously we want these protocols to be profitable, specifically the real yield ones. If they promise that these proceeds are going back to stakers, we want to make sure that that's happening. You want to make sure that you are on top of all of your positions, checking, researching, making sure that the amount that you're getting is what's on the screen, because sometimes that's just a UI bug that you're getting 30%, but you're really just getting 3%. And you have to stay on top of that and make sure that ultimately, and this is something we talked about earlier today on our mastermind call, you want to make sure you're not married to your bags. It's easy to farm with emotion. Do not farm with emotion. It's easy to do so. Getting FOMO or fear of missing out, it's a very real thing here in this space. So remember, these are your bags. You want to farm it like, and I've said this before in previous Beat the Banks things, treat this like your business, right? So you want to have a strict profit and loss. You want to make sure you're making the right decisions to make sure that your gains are protected, and treat it seriously, because that's the best way to survive in this space, or the way that we all have for years now, and we're thriving. So, all right, let's go to the position setups. We have about 10 minutes, so we'll walk through those real quick. Go ahead and stop sharing. Feel free to ask a question if you have any. Resources to research tokenomics, you can use CoinGecko, you can use CoinMarketCap. Those are the main ones. You can use DeFi Llama. Those are all great places to go. Thanks for asking that question. Let me get my Brave browser window up. All right, so yeah, here at DeFi Llama, you can check out tokenomics. You can check out all kinds of things on protocols. So for example, if I'm really curious about synthetics, up and coming, you can check to see fully diluted valuation, market cap. There could be some more info about the treasury, governance. All this stuff is here. This is all great stuff that the developer NGMI has put together to make this a really great website. I'd recommend you check out and use DeFi Llama for such a thing. I'm going to move my window up just a tad. Give me 1 second. And we'll set up our first position. So this is based on the, we did our first position previously on ETH USD, which is at the GMX website. I'm sorry, we did wrap staked ETH on DeFi Llama using the swap. We swapped and got some wrap staked ETH, right? That's what we got previously. That's what we have on this wallet. So we're going to go today. We're going to do ETH USD at GMX. GMX is probably one of the largest protocols here on the Arbitrum blockchain. Now, like I said 2 weeks ago. We start with Arbitrum now because it's the easiest to get to with regards to USDC and to ETH. That's the main reason why we do it instead of Avalanche. We used to use Avalanche, but that was when things were much different. Now you can trade native US, you can send native USDC and ETH from Coinbase down to multiple blockchains. But Arbitrum has a lot of great things going for it. It's the home of GMX, which is one of the best first positions that we can definitely recommend. So GMX is a trading platform. So we call it perpetual DEX because you can actually trade futures, you can buy spot, do limit orders. How you earn money as a GMX liquidity provider, an LPer, is you go to earn, and you have a couple different options here. They have what's called the GLP Vault, and this is GMX version 1. And the thing about GLP, and again, you can still do this. There's no reason, I mean, until the DAO votes against having GLP, they'll still have GLP. The incentives are not as good. It's just kind of the way it is because they prefer to have the GM pools. So what is the GLP Vault? GLP Vault basically provides liquidity for GMX to have these trading services, right? The original GMX, which is the GLP here, you would buy GLP tokens based on the variety of these assets. And all of these assets here provide trading services for all these assets on GMX. It's weighted. So you actually, the way that it's weighted, I believe, is 25% Ethereum, 25% Bitcoin, a small amount of Chainlink and Uniswap, and the rest is all stable coins. And that's great. You know, it worked really well, became the darling of DeFi. Tons of people put money into GMX. You earned a really great APR. It's down to 14 right now. It used to be as high as 50 that you would get every Wednesday in terms of rewards. And you can take those GLP rewards and you can sell them to whatever you like, any of these fees, any of these assets rather. And what it became was a great way to DCA into coins. So for example, if all I had was USDC and I came in and I deposited and bought $1,000 of GLP and just rode that for a little bit and then I wanted to get out, I can actually get my GLP back in USDC, or I can get it back in any of these other assets. It's a way to DCA out or dollar cost average into Ethereum, into Bitcoin, into Link, all of these really hype tokens right now. You could actually just buy them directly without ever having to swap it directly from USDC. And you have fees that you get for providing liquidity. That's where the fees come from providing liquidity to the vault. You get a weekly disbursement based on all of the fees that are done. I think it was 30% or something like that. I'll have to verify with the docs. That's me just paraphrasing. But what they did do with GMX version 2 was they moved more towards this isolated pool model. And the reason for that is they wanted deeper liquidity for all of these, for as many assets as they could get. Because before there was only like 8 there, but now we have multiples here with BTC, ETH, Solana, Arbitrum, Link, and also Dogecoin and XRP and Litecoin. These were not in the GMX V1 pool, but now you can actually have the ability to actually go into these isolated lending pools, meaning that you're just providing one asset, and then you have to actually provide 2. Well, no, you can provide 1. And you're actually providing a long exposure on one. And then in terms of the APR, it's paid back based on services of people using the pools, right? Because they're rewarding you for providing the liquidity for doing so. So that's what makes it that makes it great, specifically if you're a holder of, for example, Solana, which has been booming, right? You're going to get 47% here. This is a synthetic, first of all. This is not true native Solana, but it's a synthetic, so it's the derivative asset that's pegged to it. But you get the ability to get some solid exposure this way. What's unique about this, and again, you'll have to read the docs because I'm not a V2 holder very deeply, is that the way they've done this, they've tried to minimize as much impermanent loss as possible, mainly by just pairing it with a stable coin. That's one way, but in terms of the way that the mechanism is put together, it's supposed to limit your impermanent loss exposure as much as possible. So if you're looking to get into GMX, V2, definitely still one that we recommend. The easiest way to get into this, again, what we're going to do here is we're going to go into the ETH USDC. all you have to do is go into buy, and then in this case, you're just going to buy these GM tokens. And by doing so, you're just providing the exposure. I'm sorry, you're providing the LP for that. You don't have to do anything else. So that's the beauty of this. So I'm going to do something real quick before I do that. I'm going to go ahead and, because I just swapped, I just sent some USDC and some USDT to my Rabby wallet here. I'm going to go ahead and swap it for some ETH so I can put some ETH in here. So we'll do that by going to DeFi Llama here at the swap. I'm on Arbitrum. I want to swap for ETH. And let's do that with some USDC that I bridged over already. We'll do that with 60. So we'll change that to, let's do 20 today. And again, you can do as much as you like here. Of course, if this is your first time doing yield farming, I recommend in the first month as you're getting to know things, do not yeet or send a whole lot of money in different directions. Stick with 50 bucks, do small transactions, understand how the process works of staking and unstaking and making positions. Mainly because, and this is something that we haven't really talked about much in the past, but we should keep in mind, all of these are taxable events. So yes, you have to pay taxes on crypto. So be very careful in the beginning as you're learning how many transactions that you have. I'll be transparent. I have tens of thousands of transactions. I have a really expensive tax bill. But I do that as part of educating this community, both mastermind here and also with my personal stuff. So be very mindful of how many transactions you're doing. Make that as part of your plan moving forward in your investment plan. Obviously, it's something we talk about is sticking to the plan and making sure that you fulfill what you need to do with that plan. We'll talk about this more next week. So in this case, I'm going to go USDC, which I have .e, to getting some ETH. Whoever was asking about slippage, this is where you could actually take the slippage. I'm going to go ahead and put it down to the 0.1. And I have to choose an aggregator here. It looks like Llama Zip is going to be my best one. And I need to approve that. I need to wake up my ledger. 2 seconds. Any day now. You get faster with this. Okay. So I have not actually interacted with this before. So that's what this warning is right here. This is in Rabby. I'm not sure if you can see this, but I'm pretty sure you can't. Let me switch that. There you go. Okay, so you have a warning here. They've never interacted with this before, and that's fine because I've never used this specific one for USDC.E. So what we'll do is we'll ignore the alert because I'm good with that. And you can actually, change that, but something to look into. Standard gas, that's fine. My ledger's connected, so I want to go begin the signing process, and I have to just do that here. Again, what I'm looking for, this is part of the process. I have approved 2. And this is just for the approval, but I want to make note of the last 4 and the first 4 of what the approval is here. I'm using DeFi Llama, so I will say I'm fairly trustworthy of that, but you can, pardon me, do some extra research and make sure that the smart contracts you're using are ones that are good with that, or rather they are the exact ones that you should be interacting with. And we can certainly provide some information on that. Okay, good. So that's approved. Still the best, so I'll go ahead and swap via Llama Zip. Again, I've never heard of Llama Zip, but if it's the best based on DeFi Llama, I will go with that. And again, I want to make sure that I'm interacting with this contract, C74509X73B. I have to review the transaction here on my ledger. And I'm looking for the address. I hit the right button until I got to, and the first 5 are 0x973B, last 4 C745, which is right here on my ledger. That's exactly what I'm looking for here. So I'll keep going. They match, accept and send. Good to go. Perfect. So I now have some ETH. Now I can go back here to GMX. Give it a second to, did I do this last week? I might have done this last week because I already have some GMX ETH USDC. Not sure, to be honest. So let's go ahead and just do 0.0035. Nope, let's go 0.004. Yeah, sure. All right, so because I don't want to overdo what I have, I do want to leave some ETH because ETH is the gas token, so I want to leave some for gas. In this case, I'm getting these GM tokens, and again, I'm just holding them, and as long as I'm holding them in my wallet, I will receive some fees every week. All right, so I did want to bring this up. There is fees and price impact. It's not terrible. It's just a small amount, but it is something. But these fees that I'm making right now, these are going to go back to GM pool stakers, so keep that in mind. So I'll go ahead and confirm the buy. Rabbi will come up here. And again, I want to make sure that I am verifying the first 6 and last 4. I have interacted before, as you can tell. If not, I would get that same warning. I'm on my ledger here. I'm just making sure. Begin signing process, sorry. Still getting used to this. Normally, it just does it, which is fine. But I really do like the UI here with Rabbi. It makes it so much easier. 0x7, C68, 1 FA8 is the last 4. That matches what I have here. That's perfect. I'll go ahead and move on. And everything here seemed to be correct as well. Okay, so the buy request is in, perfect. So that is now in there. Now I have that much. So that's position number 1. That's it. I am holding GM tokens. I'm now earning this 22% APR on this position. Now there's bonus APR here. This is part of the ARB incentive. GMX was the recipient of 12 million ARB, thanks to the short-term incentive protocol with them in the beginning. So there's a lot of great incentive to farm at GMX because they just got by far the largest STIP money that's around, and they're probably going to go for more. And this is going over 5 months, I want to say, starting from October or September rather. So we've got plenty of time to just keep making money. As you can see, super deep pools, 100 million, 90 million. I mean, these are all big pools that people are getting into and making this yield. So, and this is annual percentage. So just kind of keep that in mind as you're doing your numbers. All right, next one we're going to look at is something that was on the farming spotlight. I want to look at one that was there that you guys will see most likely. Yes, the GM tokens are now my custodies. You can see this balance right here. That just means I have them in my custody. I had 3 before, but I earned an extra 11. So that is in there now. And I can verify that. Let's do that real quick. Go to transactions. And I can click here. This will pull it up. And then there's the GMX tokens that I have. Now, what I also can do is go back to here. Nope, that's not what I wanted. Still working on this. So I'm still trying to figure out the best way to do this. So, I mean, that's the transaction, but if I wanted to check it out specifically, let's see. What is my address? 0x12. I don't quite see that here. I'll just copy this out. I'll just copy it here. Copy my address. I'll come back up here to all filters and just paste in my address so I can actually just see it. And what I'll do is I'll just go here to token. It's auto airdrop to you every week, Steve. Actually, the majority of so you're getting extra yield for that, but in general, I believe your position is being auto compounded. All right, as you can see, the GMX market token. That's what I know. That's what I'm holding right here. So there you go. Okay, going back to this position 1 second. No, that's a great question. I'm glad you brought that up. It is all not short-term gains. The might have to look into the airdrop portion because they have new they put on a new memo on how they're treating airdrops. So the might have to check the Discord and see how others are playing that. Um, could be a little interesting in terms of the verbiage on how that works with the new IRS memo. All right, let's go to let's go on to Beefy Finance. And what's great about Rabby is that we can be multi-chain at all times and just go to different blockchains. So what we'll do here, and this is at beefy.finance, you'll go to just launch app, you go into app.beefy.finance, and Beefy is what we call an auto compounder. I'm way over time, but I'm going to do this with you guys so you guys can check it out, and we can check this out for you guys down the recording as well. So 2 things I want to do. I'm on Arbitrum, so that's what the filter is right now, and click on stablecoins. And this will pull up all of the stablecoin farms that they have here on Beefy. Now, Beefy is what we call an auto compounder. It's a yield optimizer, and they will actually auto compound your position 4 times per day, meaning they will go grab your position, take the harvest, swap it into the assets that are in your LP, and then compound your position for you. And they do it all in one fell swoop 4 times per day. They will only do it if your position is worthy of getting any reward. So if you have a very small position or gas is super high, they're not going to do the position because it's not in their interest to make that move for you based on gas. So just kind of keep that in mind. These are all okay. Wow, the min pool's a 38. That's interesting. The one I wanted to look at, and we'll go ahead and clear all, is on base. Go to blue chip, not blue chip, stablecoins. This one. EUSD, USDBC. Now, of course, these are quite high. The one reason why you want to use an auto compounder is you don't like or care about the reward token because you don't get the reward token here. It's all taken care of for you. They harvest it for you and put it in here. So the best way to build LP or exposure to these 2 assets is to hold them here in an LP. And when you cash them out, all of those are just building your LP as it continues to auto compound. This is a true set and forget position because you'll be able to go in and just continue to earn more. Now, I probably will not go too deeply into this because you guys can definitely do this for homework. But the one thing you'll have to do, because this is on base, you'll have to switch this. Actually, it should just automatically move over. But what you'll need to do is, obviously, you can see the rate here. You can see the ratio of what's going on here. And this is using Aerodrome, which is the top DEX on Base. Base is a layer 2 from Coinbase. So there's definitely, and these are stable coins. USDBC is the wrapped USDC stablecoin on Base. EUSD is a stablecoin from Reserve Protocol. You check our YouTube channel. We have an interview with James Glasscock, who is the head of product there. In order to provide liquidity for this, you need to do 2 things. You need to keep this window open, but you're going to add liquidity at Aerodrome, which is where you're coming in here. So, oh, sure. If you see this, just choose one or don't use it. That's fine. Connect with browser wallet. Site has been flagged as phishing by Scam Sniffer. There was an Aerodrome issue previously. We will go ahead and not do that today because there was a front end issue. I thought they'd fixed it by now, but maybe Rabby doesn't think that that's the case. So we will choose a different vault. All right, we'll go back to Arbitrum then, just keep it simple. Arbitrum stablecoins, we'll go with the one here at Uniswap, 13%. That's fine. So in order to do this, we'll click in here. You get to see, this is constant liquidity. Just keep that in mind, but they're highly correlated because they're both stablecoins. So you should have very low impermanent loss. We'll go ahead and add the liquidity. It'll take us to Uniswap, or I'm sorry, this will take us to Gamma Strategies, which is running, this is managed concentrated liquidity. So it'll automatically dynamically rebalance for you. So in order to deposit here, we'll click on deposit, and then you have to provide equal amounts of USDC and DAI. Best way to do that, if you have not done that already, of course, is to go back to Llama Swap, right? So it looks like this is native USDC, not USDC.E, because I have none here and I did previously. So we'll use my totals here. So we'll do 20 USDC to go to native USDC, which is right there. As you can see, I have zero balance there. So we'll go ahead and do that real quick. We'll choose 1 inch as our aggregator, low slippage. We'll approve here. Yes, I have to re-unlock. Fire any questions that you have in the chat. I don't have too much more time left, but I'm going over time just to show you guys how this works. Looking at the approval token here, that does match, perfect. Swap. The signing process, again, we'll review the transaction, make sure it looks good from what I was looking at. It is. Make sure I have correct contract information, which I do. Go ahead and move on. Perfect. We'll do the same for DAI. So I need DAI here, so I can just type in DAI. DAI is the decentralized, mostly decentralized stablecoin from Compound? Maker. Choose an aggregator again. Go ahead and approve. Again, this doesn't take too terribly long, but again, it is something that you need to pay attention to. When you're using a hardware wallet, again, this is for your safety, max protection gains. Again, we'll look at FCAE. Perfect. Again, you always want to approve a certain amount. You never want to approve infinite. That's where you can get into issues. Specifically, if you get compromised and they have unlimited spend, they can spend all the DAI in your wallet if they want. So always make sure you're doing a specific amount. It doesn't take an extra 5 seconds to reapprove these transactions like we're doing right now. Perfect. Pith. Pith is a great infrastructure token. We'll see where they go. And I am not familiar with Coin United, so. All right, so we've done that. We'll come back to, we should have an equal amount here. Yep, perfect. So we'll go with max DAI, perfect. Looks like it's a little more balanced towards DAI than USDC. Perfect, that's what it looks like here. We'll just approve these. And again, what's the danger here? That's fine. Ignore the alerts. Trust value less than 10,000. I understand. It's interesting that they care that much. I'm happy they do, but MetaMask never treated me in such a way. Okay. We'll do the same for DAI. And again, this is just how the decentralized trustless process works. You always have to provide permission in order for this to happen, which is what we want. Okay, perfect. Oh, it's a Pith staking platform? I guess it's fine. I mean, if you want to stake Pith, most people I know are farming it on Orca. On Solana, you get, I think, 2% per day or something like that. It's a ridiculous amount. All right, good. So we can do this here. Oh, thanks for coming, Anonymous. Appreciate you being here. See you again next Friday. See you hopefully Wednesday for our Beacon Roundtable call. Okay, so now we are here to deposit. And this is the important part. So let me get through this real quick. Make sure. Yep, that matches. All right, so we've now deposited. We now have LP tokens. So again, we're providing liquidity to get the LP tokens, and then that LP token we can then stake, and then that's where we start getting the incentivized yield. Here's the thing. If we wanted to do that here, we can. You hit deposit, and you'll start getting these rewards. It's 13% in ARB token. Personally, that's fine if you want to do that. I want to use the vault on Beefy. So I now have these LP tokens. I can deposit them here. It'll auto compound it for me. So I don't see them here. Just there they are. Now they've put in, you just click that. And now I'm going to get 13.19. Yes, it is lower than what I have here, but this is the way I wanted to go. Here, I would get this, but then I'd have to manually come and claim that every day. And that's fine. I like the auto compounding position because I just want to build more USDC, more DAI. So what you'll do there is you'll just click on deposit all, and then approval transaction. Again, all I have to do is follow these. Again, process this. I understand that. I've never done this on Beefy, so they're just going to ask. And that's fine. We'll begin the signing process. And again, I'm making sure that these approvals match in terms of the numbers, which it does. And now as for the approval, this is now to deposit. So I'm looking for OFV9. We'll begin the signing process. OX6136. So yep, perfect. There, it's deposited. So now it'll show up in my positions. There you go. Now, there is no deposit withdrawal fee, but there is a performance fee. I'm trying to see where the performance fee is. They'll normally list it if there's a performance fee. I don't see it. But they do charge a performance fee. There it is, sorry. You just hover right here. In this case, it's 9.5%. And that goes back to the Beefy stakers and the Beefy treasury. Now, if you want to be a Beefy holder, you can buy Beefy. It's $400 a token. It's fixed supply. But you do get a piece of every single vault that comes through. So it does have utility as a governance token. So keep that in mind based on what we talked about today. And yeah, so now we have two positions that you can go and practice with. There's a Beefy finance vault, a set and forget auto compounder, and then the GMX position on V2 at one of the largest protocols in all of DeFi. So definitely check out Orca, Steve. Good stuff. All right. That's all we have for today. Again, I'm way over time. I don't normally go this long. It'll be just for an hour most days, but feel free to come visit us on our YouTube channel. I want to be a part of your journey. I'm here to partner with you to make sure that you're finding the right amount of success. That's what we do here at Beacon. And happy to have you here with us. Have a great weekend. And again, reach out if you need anything.